high net worth specialist lending, retirement interest only.
This is where there's no end date.
If I would live to 110?
Correct, if you're living to the 110.
Wow.
So with standard mortgages, we don't have to apply what's called the death stress test. Sounds really horrible.
Death stress test. In the world of specialist lending, anything is possible, and I'm so pleased and delighted to be joined by Paul today, and we're going to talk about later life lending, specialist later life buy-to-lets, and high net worth lending. Paul, welcome.
Good morning, Paul. Nice to see you.
And you likewise. So, in the world of specialist lending, what does that actually mean?
So in terms of family building society, and for those of you who don't know who family building society is, we were national counties, been around since 1896. As a smaller mutual society, we can't compete with the high street. We have to look at different ways and different types of clients that we can look after. And a huge proportion of what we do is later life lending.
So later life lending, my understanding is if you're 65 up to age 89, yes, you can potentially lend.
You're almost right. We will lend on interest only up to 89 at the last starting point, and 90 on capital and interest, 89 on buy-to-let.
Wow, so if you're still looking to buy investment property age 89, there is a lender that can help. So later life, specialist lending, family building society, you may have not heard of them, but they're a fantastic building society and a specialist building society at that.
Yep, very much so.
And where do you compete in terms of size? You know, how large is the society in terms of all of these charts and things for those that don't know who you are?
So we're the 11th largest building society, so I would describe us as the biggest of the small building societies. If you perhaps compare us to somebody like Skipton, they're the 4th biggest, but roughly in terms of size of lending, they'll be about £4 billion more in lending than we do. But we don't try and compete with those guys. We're competing with the ones perhaps lower than we are in the table.
So Paul, retirement interest only mortgages, what does that mean?
So, there are actually 3 types of really lending that we would do in later life.
So later life lending, just for those, is retirement. So anyone that's aged over...
Anybody in reality, anybody aged over the age of 55.
55, so 55 plus, there are potential solutions which we term as later life lending.
Correct.
And so many people would have thought historically that you can't get a mortgage and all mortgages need to be repaid at 65. I know many of the high street banks are probably writing to people saying, pay off your mortgage, pay off your mortgage. But don't worry, there are solutions. So there are 3 potential solutions. What are they?
3 potential solutions. It really depends on what the client wants to do. So number 1 option is straightforward interest-only lending. You'll have many clients who still need interest-only. They want to borrow in later life. They might want to just borrow to stay in their existing home. They might want to borrow to gift to family members because they're trying to do some inheritance tax planning. Or they just need further funds. They want to borrow some more funds, they want to do home improvements, live life a little bit, but do home improvements on the property. But there are options for them. And those options remain right on interest only right the way through to the age of 89. Okay? We'll go up to 80% loan to value. We'll go up to 70% loan to value with downsizing as the primary repayment vehicle with standard interest only.
So you could be selling a house for say 700,000 and buying a house at 400,000, and you could potentially lend up to 80% of the purchase price of the lower transaction.
Correct. If they've got other assets in the background, so they might have buy-to-lets, we can use those as additional repayment vehicles. We'll just do 70% with downsizing as the primary vehicle. If they want up to the 80%, they'll either need another asset in the UK or investments in the UK that we can use as to help them do the downsizing.
So we've got 3 options. We've got interest only.
Yep, capital and interest. Yep.
So basically you could age 65, take out a 25-year repayment mortgage.
We'll actually let you do up to a 30-year repayment mortgage. So that would go to the age of 95, Paul. Correct. And the main reason for that is the debt is reducing. It's not a flat debt as interest only potentially is. So when we were talking to the regulator about how we were going to do ages, that's one of the key things we talked about, is this is a repayment debt, it will reduce, therefore the risks become lower as they get older. So that's why we go to the age of 95.
And the third one is retirement interest only. What's the difference between that and normal interest only?
Okay, this is where there's no end date to the mortgage. So this can keep going forever effectively.
If I would live to 110?
Correct, if you're living to the 110.
Wow.
The main difference is how we assess the income for that mortgage. So with standard mortgages, we don't have to apply what's called the death stress test. Sounds really horrible, but
Death stress test.
death stress test.
So with retirement interest only, there is a death stress test,
Correct.
which is only applicable on, we'll call it RIOs, retirement interest only mortgages.
Yes.
Okay, death stress test.
And that, therefore, is if you've got two applicants looking for the mortgage, we'll always look at the lowest earning income first, and then what transferable benefits from the second person's income to use as well.
Okay, let's start again. So let's run a scenario. I'm looking to borrow 300,000 to buy a house that is 500,000 and I'm downsizing.
On standard interest only, we'd use both incomes, not
Right.
a problem.
Okay,
With a retirement interest only, the first thing you'd find is you're restricted to 50% loan to value.
okay. Why is that? So educate us.
Okay, because it's just a never-ending debt. So as a
Okay.
responsible business, we keep it at 50%.
Okay, so if I wanted 250 and 500 on a retirement interest only mortgage, that mortgage could last till I'm 110 and you do 50% loan to value max. But from an underwriting perspective, you assess the lowest income that's being received.
Correct, plus what transferable benefits the other applicant has.
So when you say transferable benefits, what do you mean by that?
So if you've got a client, the first applicant has £50,000 worth of pension income, but you'll often find maybe only 50% or less will transfer
I'm with you.
on death to the other applicant.
So you have 50,000 of potential income and upon death by one partner, 25,000 is then passed to the other. And so you take the lowest income generating person plus the transferable benefits, that's their total income, and then it's stressed.
Affordability driven.
So it's affordability driven, so it's not a credit score based.
There's no credit
No
score
credit
basis.
score.
So we manually underwrite all our cases. There's no credit scoring. All we will do is a credit check of the client just to make sure that they pay their bills and debts on time.
So this is amazing. So you can potentially lend to 110, 50% maximum loan to value, and it's based on affordability. So therefore, if I was to take a 5-year fixed rate, does that allow more freedom with affordability, or
We only have a 5-year fixed rate for retirement
well, I didn't
interest
know
only.
that. So there you go. So you only offer a 5-year fixed
Indeed,
rate.
and that will help, especially if they've got any other outgoings. You'll find that the affordability will be stretched a little bit further than if they were using if there was a 2-year fix, if they were using.
And then for those that are listening and watching and learning, is it an income multiplier as a guide, or you say affordability? So let's say my income is £10, my living costs are £3, so I've got £7 of disposable income, then that could then, if my mortgage is going to be £4, how is that treated and assessed?
As a rough guide for you on joint income, you'll find with reasonable income it will get you to roughly 4.5 times income. The more debt the client has, the lower that multiple then becomes, but again a 5-year fix will help push that back a little bit. Single applicants will be closer to 4 times or less. The higher the income, the further that will always get towards
Because
that
it's
4.5
more
times
for
income.
affordability.
Correct.
Okay,
Yeah.
so
Obviously if it's two incomes that are quite low, the actual cost of living affects that far greater than somebody earning £150,000 a year.
that's incredible. So you can do retirement interest only is forever, max loan 50%. Generally speaking, joint applicants, it roughly comes out about 4.5 times income. You have a 5-year fix, but there are a little bit of variables and flexibility. And then let's say I've got an investment portfolio of 300,000 and that produces an income and is growing, but I don't draw it. Can you add investable assets to that calculation?
So we don't particularly do that for RIO.
Okay.
We will do it for standard interest only mortgages.
And why the difference to educate me and others?
Again, it's because of how long that person could potentially live and how long you're using that
So I might
asset
live
for.
another 50 years if I'm 60,
Correct.
and that money, you would expect it's going to be used and paid.
Correct.
So you're just purely relying on retirement income, what's guaranteed to be paid, and that's going to be probably pensionable income
Correct.
rather than investable income.
Correct. As a general rule of thumb, on a retirement interest only, it will be far stricter in terms of what incomes we will use compared to standard interest only or capital and interest.
My personal belief from an inheritance tax planning perspective is that you're probably better off passing away with debt or with mortgages because it reduces your tax liability, and then having a retirement interest only mortgage is a great potential tool rather than gifting assets and or taking life cover. And obviously always seek professional advice when arranging these things. So that's retirement interest only, which sounds really amazing because I never knew you could lend to 110. And then interest only, is maximum 95 on a repayment mortgage.
So capital and interest, C&I, maximum 95 at the end of the term. With standard interest only mortgages, the last time we will allow somebody to apply is 89 years of age and offer them a 5-year term.
So that last age on applying is 89, 5-year term, interest only. And is there a max loan to value, what, 70 to 80% again?
Maximum 70 to 80%. What I would just say to you is, Paul, a huge proportion of what we see are clients coming to us between the ages of 60 and 80 for these interest-only mortgages. They tend to still be below 60% loan to value, even though they're standard interest only rather than RIO, but we will comfortably allow somebody to go to 70 or 80% depending on their personal circumstances. But a large proportion of what we do will always be under 60% loan to value.
That's incredible. So let's just say I've received some inheritance, I'm 65 years young, I've got my main home, and I want to go and buy my first buy-to-let property as a pensioner, and I'm retired. Is that possible?
It absolutely is possible. If you're a homeowner at this moment in time, we will consider you for a buy-to-let mortgage.
That's amazing. And are there any sort of minimum loan sizes and maximum loan sizes?
Not technically a maximum loan size. Generally speaking, our minimum loan on most loans is £45,000. Our maximum loan to value on buy-to-let at the moment is 70%. As a lender, we don't currently need to go beyond that. We do plenty of buy-to-let at those LTVs. We will do standard buy-to-let for the client, so a straightforward residential buy-to-let.
Okay.
We'll do limited company buy-to-let, as it says. We'll do expat buy-to-let. So for those clients with UK passports living abroad in a multitude of countries, we'll do those. And actually, we also do offset buy-to-let.
Offset buy-to-let.
Offset buy-to-let.
For retirement or for anyone?
Anyone, but
Offset
retirement includes. And we will allow the client to offset up to 100% of the interest-only payment for the buy-to-let.
Learning something every day. Amazing.
Big one for your landlords. Specifically for those, be they the older landlord or the younger landlord, if they've got portfolios of buy-to-lets, if they've got one perhaps that's unencumbered, we will allow them to borrow to put back into the offset account and then utilise that to go and buy new property, do repairs, renewals. We look at the green agenda potentially. Clients, rather than having to go and get second charges or keep doing further advances on other properties, they can have a pot of funds here that they can keep flipping over and around by pulling some out, putting some back in from the rents that they're receiving. It's almost like a flexible cash plan for them.
That's a very clever thing to be doing by having an offset buy-to-let if you're a landlord specialist with a portfolio.
Especially now with the ability not to offset interest the same as you used to be able to do.
That's a very unique point. We'll have to come back to that and cover. And then the other thing you do is, working with you for a number of years, is high net worth specialist lending. Generally, how does that look like? And so from my understanding, high net worth exemption is normally a minimum of 3 million of assets and 300,000 of income. So what does that look like from a lender's perspective?
So we're looking at these cases very much on an individual basis. We are the size that we are as a building society. We don't technically have a maximum loan size as to what we do. We're just driven by LTV in most cases. But we're looking at clients who've got assets. They might have large portfolios of stocks and shares. They might have offshore wealth funds. They might have large SIP funds, large pension funds, large investments, gold, all those kinds of things. Lots of property in the background. Not everybody's cash rich at the time, and we can look at those clients and bend and shape our criteria to try and help them obtain a mortgage, usually at a sensible loan to value, and perhaps help them where the high street won't.
How do I calculate my income to get a mortgage when I've got other assets?
So for clients who are over the age of 55 at this moment in time with current regulation, something like a SIP pot, provided it's investment driven rather than property driven, and I'll come back to property in a minute, but we will look at what term you want first of all. So if, Paul, you're looking for a client who wants a 10-year interest-only mortgage with us and they've got £1 million in their SIP, we will take 90% of the value of that SIP, so £900,000. We'll divide it by the number of years you want to do the mortgage over, 10.
Okay, so 900,000 divided by 10, 90,000, yeah.
We'll also, if you want to be a little shorter in term, and you might have clients who are slightly older, or they need a mortgage over a shorter term, but we know there's other assets, etc. in the background, we can look at 80% of the value and divide that by as little as 5 years and use that as income.
So 800,000 divided by 5, that then becomes my income, and then it's stress tested and affordability subject to loan to values.
Correct.
So using your other assets which you call monetising your assets.
So if you've got a client with an investment portfolio, it might be a wealth management fund, might be an offshore fund on the Isle of Man, you might have large ISAs, you might have FTSE 100 stocks and shares. We can potentially turn all those into income by using a similar calculation.
That's fascinating. Always learning. If you have questions, please comment below and we'll be delighted to introduce you to Paul at the Family Building Society to answer those questions. Paul, thank you very much.
Pleasure, Paul.